So you've done a wonderful job at raising some money. You know, you touched on it earlier, a local harmony lender. I think that's one of their probably a challenge in their success is they can't loan out more than what they have. So what are the key factors that, you know, help you to your success in securing the capital so that you make sure you don't ever run out of money to loan out?
Yeah, and you know, we started like every local lender back in the day. Now, we had more equity to work with than most lenders because of the nature of our ownership. But the reality is we were capital constrained the way every single lender was back in the day. And even today, as small lenders get started, sooner or later, you just run out of money. And the way we started was certainly like that. And then eventually, what we really worked on was the ability to be able to warehouse loans with regional banks. And what basically that means is they give us lines of credit where we participate in that loan with our money, and then they fund a portion of it. And that helps us exponentially grow. And then as time goes on, especially in the short-term stuff, we build out that portfolio, and then it pays off anywhere, usually 6 to 12 months, and it becomes like a revolver. And we make sure that that warehouse capacity, that ability to fund internally, never gets to the max, right? How do you get there? Well, it's mostly track record. Track record is what's going to get you there. Certified financial, audited financials. All these things help different warehouse providers give you that certainty that you're going to be a good steward. And then, of course, on the other side of that is equity. You have to have participation equity to go along with whatever sense of financing. And that equity is oftentimes why smaller lenders run out of money, It's because they just run out of equity. And even if they have some secondary form of financing, they're out. And once you're out, it doesn't make a difference whether or not you have that line or not. It's something that we've really focused on to reinvest in the business and make sure that we have that sense of capital. Now, the other side of things, very, very different, is the rental loans. Now, the rental loan, we're writing 30-year loans. We have no interest in holding 30-year loans on our books. But what we do is we close them with our own money, we hold them, and then we package them together, and different entities will take them off our hands for the long term. Could be insurance, could be hedge funds, could be large capital institutions, names you would recognize out of New York. All of these sort of longer term debt solutions are looking for locked in long-term rates. And that's where the 30-year stuff comes in. And once again, it's track record. How is RC formed? How is a lender? Are we doing good underwriting? Are the loans that we've written 1, 2, 3 years ago on the long-term side, are they performing? That track record goes a long way in being able to find those capital partners. They're going to help you build out a rental portfolio.
You took that word out of my mouth. I was going to ask you, usually are they performing notes or non-performing notes?
That's right. You know, as a lender, we have to always look at every single dollar, whether it be our money, the warehouse money, the insurance, wherever our loan is going to end up, we have to write every single loan as if we're writing a check out of our bank account, right? Like as if it's our own money. Because that track record, to your point, track record is everything. We want every loan to perform for the life of that loan.
Do you see that people actually hold their note for 30 years, or what's the average on that?
Well, what's interesting is most of the loans that we've written on the rental side over the past 5 to 7 years, there was a big refinancing boom after COVID.
Yeah.
So a lot of that paper, 22, that we wrote before that got refinanced. Rates went down, right?
Right.
Even if there was a prepayment penalty, because the rates went so low, it was worth it. And as rates have come back up, all those loans are basically staying where they are. But to really get to the crux of it is, it's an interest rate driven equation. It's a math equation. If rental rates go below a certain level, is it worth for me to refinance?